But let me quickly get down to what I wanted to say. This session is, as you know, on trying to look at financial and economic policies for inclusive and equitable development. And we sort of presume that this is necessarily a laudable sort of project or effort to make, essentially because of the fact that there is a belief that there is something we can do in the current context to make the trajectory of development as it occurs more inclusive and perhaps more equitable too. What is the difficulty with this? The difficulty is that if you look at the current consensus, I would say broad consensus on global development, there are two sort of contradictory tendencies. The first, of course, is something which comes out of, you can say, belief or a kind of mainstream theory which is under question, the notion that that actually existing market economies are precisely the tools that we need in order to be able to ensure productivity increase, growth, and an ever-widening delivery of goods and services to what is an increasingly consumerist society. That is, from the point of view of growth and economic development, a market economy which is less regulated or unregulated in large measure is the one which is able to deliver as far as growth, productivity increase, etc. are concerned. On the other is growing evidence on which too there is a certain degree of consensus, I suppose highlighted by the sort of star status which was given to Piketty when he discovered or put together very, very solid work to actually show that there's been a significant increase in inequality. Of course, it wasn't received with the same degree of celebration when it came out in French, I understand. But then once it was translated to English and he went to Washington, suddenly the world began to discover that the process of development that we have is deeply inequalizing. And of course, there is increasing evidence because of the discussion on climate change that that process of development also is not only one which is not able to absorb the labor force in full, resulting in persisting unemployment, but also is one which actually is extremely destructive of the environment, which leads to mass displacement in many contexts, and perhaps even to a certain extent results in persistent war in different theaters across the globe, even if not in a world war. Now, this kind of perception that of the first kind, that actually existing market economies are very useful from the point of view of promoting growth, has of course been strengthened by the fact that we've seen the collapse now 2.5 decades since then, to the collapse of actually existing centrally planned economies or socialisms, whatever you want to call it. And it's also because of the fact that we've seen now the emergence and consolidation, some say successful consolidation, of hybrid forms of market economy of the kind that we see in countries like China. So therefore, there seems to be this problem. How exactly do we deal with the fact that we have a kind of growth trajectory which is important from the point of view of successful growth, but it's a trajectory which somehow seems to deliver also unemployment, it delivers social deprivation which is unacceptable, it delivers displacement and environmental degradation, and we are ending up with a situation in which there is some kind of an implicit acceptance of a twofold strategy. When it comes to growth, let the market be treated as benign and operate without much intervention. But then we need public action. We need the state to intervene in order to be able to deal with the adverse consequences of this trajectory of growth or trajectory of growth under what is a more liberalized, sort of more open capitalism which has come to prevail in the neoliberal era. Now, the difficulty with this kind of argument, of course, is that it makes the assumption that the ability of states to intervene in order to be able to have strong public action to deal with, let us say, unemployment, deprivation, the environment, whatever it may be, is not in itself undermined. It's not in itself undermined by the fact that you're pursuing a certain growth trajectory. The most obvious way in which this comes through is the centrality of the notion of fiscal consolidation in a context in which you see the role of the state as being one of facilitating and incentivizing the private sector and therefore taxing less over a period of time, that if you combine lower taxation or a more lenient tax regime with the policy of fiscal consolidation or reduction in deficit spending, obviously you're going to, in some sense, emaciate the state, its ability to be able to deal with these problems, so that this distinction which we are making between, unfortunately, having to accept a growth strategy, or not we are making, but many people make, of having a growth strategy which is actually good from the point of view of development, but bad from the point of view of sort of social and environmental outcomes, with public action, that this actually cannot occur is really something which we have to take into account. So when we speak of the need to have inclusive and equitable development, maybe we are actually entering a terrain of discourse where we are partly giving the struggle away, we are partly giving the game away, in as much as we are admitting that it's possible to have this growth strategy, but then we can have the MDGs, then we can have the SDGs, we can realize that much of it is not realized at a certain point of time, and then have another set of whatever, post-millennial development goals or post-sustainable development goals or whatever it may be. So we put that on the agenda, but we don't actually see the fact that the trajectory that we are pursuing otherwise is one which will not allow you to realize this agenda. I just want to give a very brief illustration in this regard, and this is to touch on finance, which is, in the past, we basically had the understanding that to the extent that you need to use finance or financial structures and financial policies as an instrumentality for both development and to have a certain degree of broad-based growth, which is also to a certain extent, if you want to call it inclusive, is that you need two kinds of things. One was mentioned, you basically need a substantial part of your financial system in which the profit objective is not the dominant objective. You can have cooperatives, you can have public banks, etc. This is because of the fact that if you have to deliver credit to widely dispersed, sometimes remotely located clients who borrow in small amounts, the transaction costs are so high that you end up in a situation that to make profits out of such lending becomes extremely difficult, though you need to do such lending in order to be able to achieve these objectives if you want to use finances as a trajectory. So the way in which this was resolved is to say that, listen, let's think of institutions like public banks, which don't have profits as their principal objective, or we think of institutions like cooperatives, for example. Now, if you look at the current environment, this has been replaced by a whole notion that no, as part of a growth trajectory which is trying to get credit to high-yielding projects, we should get the banks out of, let us say, rural areas. But we have to find other ways of trying to actually reach these people who need to be reached in order for growth to be inclusive and to a certain extent equitable. So what do we have? We have banking correspondents, we have payments, what are called payments banks and so on, and we have microfinance. And just look at what microfinance is. Microfinance is a way in which finance is saying that, listen, we don't want to be there in a brick and mortar sense, but we don't want to lose the profits which you can get from the bottom of the pyramid. So I give the money to a set of institutions which then can use things like self-help groups which are self-regulating, can use methods of recovery which are extremely severe in order to be able to lend at extremely high rates of interest and actually get significant profits even after giving a significant part of the margin to the original lenders, which are the banks. And similarly, you have many of these firms listing, and you end up with the fact that they are extremely successful on the stock market, and this essentially results in a situation where they have to raise their interest rates even further. The net result of that has been, what do we have? We have people borrowing from one mutual finance institution to repay another institution. You have people who actually have multiple loans operating at the same point of time. You're not able to default because of the fact that there's peer pressure, and you have things like suicides. So you actually have a situation where you're actually transforming the financial sector to make it inclusive, but in actual fact, what you're doing is not coming to terms with the fact that the fundamental trajectory that you're pursuing is a trajectory that is not most suited from the point of view of ensuring inclusiveness. So the implication, and I conclude with that, the implication is that if you want inclusiveness, it's not enough to have the MDGs and the SDGs. We have to go back and rethink trajectories of development and to come to terms with the fact that the current trajectory is one which can never be inclusive. Thank you.